Hi, I'm Chris Sugden, Managing Partner at Edison Partners and your host of Electrifying Growth. This is Sit Down with Sugden, where I share from my experiences as both the investor and an operator to help you get that next stage of growth.
Hey everyone, thanks for joining me again. Another episode of Sit Down with Sugden. So first of all, grow at all costs. What happened and why is this sort of topic of profitable growth and working capital negative because you don't need working capital to grow your company? How did that shift change? If you think about where I deploy a dollar as an equity investor or where my investors, limited partners, deploy a dollar, public markets, private markets, stocks, bonds, crypto, real estate, when the Fed interest rates were zero or near zero, the trade was clearly private equity, public markets, because I'm getting the money for free. And basically, because I have no cost of capital or very, very low cost of capital, I was getting paid to grow. Now that capital is a higher cost to it. Now I'm faced as an entrepreneur, as a founder, with the trade-off that equity investors are going, I need a risk-adjusted return on that capital. So now if I'm losing money and that money costs me something, that's not a good trade. Bonds now, higher yield. If you've been reading about the bond market having dislocation because of tariffs, that's a different topic for a different sit down. But the point is, bonds weren't a great place to put your money, right? The rates were so low, it was a bad trade. Again, era of free money, ZIRP, zero interest rate policy. Like our kids are going to be reading about that crazy time when the Feds lowered rates to zero and just held them there for a really long time and all the crazy behavior created in capital markets, both public and private. And I think as an entrepreneur, if you were building your business sort of in the 17, 18, 19, 20 and headed right into COVID, and then all of a sudden money became free, you've been sort of taught as an entrepreneur, as a founder, as a business builder, grow. Then in 22, when the whole market shifted, rates start to go up, and people like us said, we want to see you be profitable. It's like whiplash. We don't want to see you stop growing. We want to see you grow profitably. That's a hard thing to do if you've designed your business model to grow at 100% and be okay with losing 40, 50, 60% of EBITDA margins. How do you stop that train overnight? You have to cut lots of people. There was a forcing function, which was the private equity money, the capital markets seized up. People weren't putting money to work. So everyone got religion really fast, but it stayed in place. So 22, 23, oh my God, downsize and get my business the right size to be profitable. Now I've accomplished that. Can I grow again? So now what the markets are rewarding is this, what we call durable growth. And again, in our growth index, you see a definition of it. It's, to keep it simple, are your unit economics right? And from a working capital perspective, are you a more attractive business than a less attractive one that needs to consume a lot of capital to grow? And I think it's almost was unfair. I remember sitting in board meetings for the same company. It was like literally like a light switch getting flipped. One day I'm supposed to grow at all costs, and there's the next round of capitals around the corner. And the next day, there's no free money, and I'm supposed to be profitable. But board, we talked about, I'm building a sales team. I'm supposed to develop the next product. I'm supposed to invest all this money. So plenty of meetings during the course of the end of 22, 23, and even into 24 around this mind shift change. I would posit to all of you out there listening that this isn't changing back anytime soon. Will the Fed eventually lower rates? Yes. Back to focusing on what we can control, we can't figure out when. The market has spoken for literally 10, 20, 30 years, but clearly in the last 30, 25 plus, I date myself, when we've moved to a software as a service model, these rule of 40 businesses or 50 or 60 businesses that were growing nicely, 30% and at 30% EBITDA margins at some kind of scale, north of 50 million, north of 100 million, north of 200 million in revenue, were really, really valuable. That was my point about the revenue multiple or EBITDA multiple being higher when you look at what the ultimate value, how the market values your business when you ultimately go to sell it. So it doesn't take a rocket scientist or a great crystal ball to predict profitable, responsible, or as we've called it at Edison, durable growth. Isn't this passing fad? I'm sure we'll have it again because cycles tend to repeat themselves. We'll see free money or some sort of lurch for higher growth will happen again. I would just say, be careful. It's probably a fleeting moment in time, whether you can take advantage of it fast enough to then adjust back. The lesson I think we learned from this last run up and run down if you don't have a durable growth company, you face there's bigger odds you fail than you do get to the other side if you're not in control of your own destiny. Again, I want to keep pointing you to the growth index. I don't want to give all our total secrets away because they're out there for you to consume. But you think about things like how you charge your customer. Am I taking a really big Bank of America as a customer, and am I letting them have my accounts receivable sit for 90, 120, 180 days? It really means I'm financing as a small company, Bank of America. Does that make any sense? No. Charge up front, charge sooner. That's one. So what's my working capital, free cash flow situation in my business? And good news is most non-venture backed, non-private equity backed companies run more like a candy store model. So you actually tend to have better habits than those of us who have other people's money funding them. So keep doing that if that's the way you run your business. From the standpoint of those who have the opportunity to grow faster because third-party capital has come in to help you grow faster, think about things like customer retention and churn. Because the first thing we go to test whether you're a durable growth company is gross margin. There's best-in-class gross margin. Again, in our growth index, you'll find those numbers. I don't want to give away the total trade secret, but it's out there in the public domain. There's also retention rates, but you need to look at the two ways: net retention and gross retention. What do I mean by that? As you upsell your current customers, that's one measure of gross retention. So all my customers, how did my revenue grow? That's gross. At a net level, am I losing customers out the back end? Is my bucket leaky? Right? So I've got to replace those, but my current customers are growing so fast that it looks like on the surface I'm growing really well. But do I have a churn problem that is being masked by upsells of my current existing customers? I hope that makes sense. Net retention, gross retention, best in class, well north of 100% from a gross retention basis. Net retention, there's different models out there. Edison makes the case that you want to be north of 85, probably even north of 90. But go take a look at this information in our growth index. And I think you'll find some really, really helpful tips. And we actually give you real data. It's third party and our portfolio companies that look just like you, sort of software technology companies, but it does apply actually to non-technology companies as well. So in closing, while numbers can be mind-numbing, and I didn't give you a bunch of specific statistics for a reason because they can be so mind-numbing, let's just think about it this way. And again, if you're an entrepreneur out there that's been building your business the quote-unquote old-fashioned way, bootstrapping, customer-funded development, you didn't use third-party capital, maybe you did get some angel money to get off the ground, you may already be doing this because you have no choice. You have to be profitable every year or you go out of business. I think the mindset from a durable growth company is just that. How can I make sure I control my own destiny? Back to the Stoics, control what we can control. Whether you're a rule of 30, 40, 50, or 60, if you're a profitable growing business, you're not going to rely on or be subject to the whims of the private equity, growth equity, venture capital markets. Are we funding at a high volume or not, or at a high valuation or not? Because you're going to choose when you need to transact. Again, you're in control of your own destiny. So I think that's the kind of capital, bold, underline kind of point of durable growth. You're in control of your business. When you raise money, if you ever raise money, when you sell your company, if you ever sell your company, if you're growing and profitable, it's up to you. You're not going to be forced to do a transaction. There is a saying, it has been true in my 23 or 4 years at Edison, great outcomes in terms of great companies are bought, not sold. You know, we've all done real estate transactions probably out there. Someone's knocked on your door when it was a heyday of real estate. Can I buy your house? Put a sales sign on it. There's already a pocket offer by a realtor. Same thing. You're a strategic buyer. You're choosing when to transact. If you think about, if you have to go sell your company because you have to, what are the odds of getting a great outcome? Because the buyers can sniff it out. Versus I'm going to go see if the buyers out there have an interest in buying my business from me because it's a great business and I don't have to transact. Again, you're in control of your own destiny.
Thank you for joining this episode of Electrifying Growth. For more resources, inspiration, and a look inside the Edison Partners network, sign up for our newsletter at www.edisonpartners.com. Click on the Stay in the Know button in the top right corner of our webpage. Thank you again.